Roger, can you hear me?
Yes, I can, Simon. Can you hear
Awesome.
me all right?
Welcome.
Thank you.
Great to see you. So thanks for coming on the show. This is our expert interview series or expert investor interview series, and thought what a great chance to chat. You've got many years experience investing. I know you run your own super fund, and I've read some of your stories on your website about trying to get some professional help. It hasn't always worked out as planned, and you sort of, learned by personal experience what works and what doesn't. And also a very accomplished author, I might add. You've got 5 books published. Is that correct?
Yes, I got 5 books. I brought them here. They're all there.
Fantastic. Look at that.
They're the latest editions.
Awesome. So I'm sure we'll touch on some of those today. But yeah, thanks for joining us. So the plan is to just have a bit of a chat about a couple of different things that I think our subscribers and yours might like to hear. So how does that sound?
Yeah, sounds good to me.
Fantastic. So I guess what are some of the biggest mistakes you see new investors making, and how could they avoid them? What are your thoughts?
Well, I, I speak from my own personal experience, basically, because generally people don't like to tell you when they have made mistakes. They just say, I've lost some money here or there. They don't really tell you what the mistake was.
Yeah.
Um, Well, I think one of the mistakes I've made, and I still tend to continue doing, even though I know I shouldn't do it, is I equate a good product to a good company and therefore to a good share. So you sort of read up about something and they say, gee, that's a good idea, well, that's a great product. Wow, I've got to get on board this. And I found from bitter experience that it doesn't always work out. In fact, it quite often doesn't work out. And so having a good product doesn't guarantee you're going to have a good investment and make money on it. I think not having a good product does. It's pretty hard to be successful on the market unless there's a good product that's
Hmm.
got public acceptance
Hmm.
and it can make money for the company. But just having a good product doesn't necessarily equate to making good profits and having making a lot of money. And a lot of companies I know of that have got what I would consider a very good product, yet they can't make money, and eventually some of them even fold up. And it seems a great shame because what what was a great product doesn't turn out to be a good investment. So I would always caution investors to always look at other things other than the fact that, hey, this is a good product. Now, the other thing I think investors, new investors tend to make, and I guess I did this too for the first few years, is you follow the advice of the experts. Um, and I don't like the word expert. I don't like even being called an expert, I have, I think it's sort of, I don't know. It's not a term I like to use. I think I'm like everybody else. I find my way in the market. I make my mistakes. I have ups. I have the downs, and but I certainly have had a lot of experience. So if experience makes you an expert, then I guess I'm an expert. But I
It's a
would
good
like to say
start.
that I've had a lot of experiences. I've learned from my mistakes, and I think I'm able to communicate that to others. This is, I think, one of my fortes. I was a tape teacher for 27 years, full time, and then I taught part time for another 10 or 12 years after that. And a few years before, I was full time. So I've had about 40 odd years of experience in teaching. And I think that one of this, one of my strengths is that I can explain things in terms that others can understand, and that's what I've tried to do. And my latest book, which is called Starting with Shares, I'm particularly trying to do that.
Yeah.
And what I've done is I've interspersed it with lots of illustrations, so it's more or less like a comic book, like there's a typical page, and you can see that the
Yeah.
whole page is just about devoted to illustrations, because I think illustrations are a great way of teaching something, getting a point across. And actually, the illustrations aren't as, there aren't as many, or as they're not as large as I really wanted in a book, but it, it makes it a lot easier, I think, to read and understand. Um, so I, as I said, I think uh, that people tend, when they start investing, they say, "Oh, this is a very complicated thing. There's so many things to think about, and oh, I can't possibly work my way around all this. I better go and talk to someone." So they talk to somebody who says, "Oh, yeah, well, they're an expert," and they give them advice, and often they blindly follow that advice for no other reason than they were told that this should be a good investment. Invest in this
Yeah.
company because it's going to be a good investment, isn't it? And
Yeah.
I think that what people have got to do is they've got to start out by saying, "I'm going to take responsibility for my own decisions. I'm
True.
not going to lie to others. I'm going to take responsibility for my own decisions."
Yeah.
Well, I think
Yeah.
it's a bit like if you consider going to a doctor, we tend to sort of go to a doctor and the doctor gives us some advice, tells us to take some medication, and we generally just sort of take it without much thought. Or the
Yeah.
doctor says you better go and have such and such a test and do something else.
Yeah.
And we tend to follow it because the doctor is the expert. But
Trust.
I think nowadays people are getting more and more aware that they've also got to take responsibility for their own health.
Yeah.
You can't expect someone else to say, "Well, this is what you need to do to be healthy." They've got to find out for themselves, and they've got to work on their own health plan. And whenever they go to the doctor, they've always got to have an idea in the back of their mind, "Well, this is what I think could be the problem, or
Yeah.
what's the solution going to be?" And rather than just blindly take that doctor's advice.
Yep.
The
Well, that's
doctors
so
are, well, the doctors do 6 years of full-time study, and
yeah.
then they've got to do many years of internship before they can class themselves as a reasonable doctor. But I don't think share investing is anything near that level of complexity. I think I could teach someone to be a pretty darn good share investor after maybe a month,
Yeah.
or possibly just reading through one of my books. That book would give
Right.
you an awfully good start.
Yeah.
You want to get into it.
But it sounds like yeah, it sounds like what you're saying
The
is
book's called Teach Yourself About Shares.
yeah.
If you work your way through that and did all the exercises in there and
Yeah.
follow them all and look up all the solutions and work it all out, you could be a pretty good investor. Now, I think that shouldn't take you more than probably a month of reasonable study. So you should be able to get to a level of proficiency where you can make some pretty sound decisions on your own. So, but whether or not you get to that point, I think you've always got to bear in mind that you have to take responsibility for your own financial state.
Yeah.
Right? And no one else can take that for you. You have to take that responsibility, and you have to start out with the idea of, yes, I'm going to take the responsibility myself for my investment decisions,
Yeah.
and I'm not going to follow someone else's advice.
And look, that's yeah, I think that's a great point. Self in a way, like your doctor's example, a little bit of critical thinking or self-reflection, self-education, or all those areas. It doesn't mean at a time you mightn't engage a professional, but certainly self-education, there's so much information out there, the great books that you've written and resources, and it's just about having that, I think, picking something up and starting to educate yourself, right? And then the other thing which you benefit from, and I think any can help anyone really, is time, right? Living through different investment cycles and markets, and surviving bear markets and bull markets, and all in between, and that only comes with experience. So step one is what you're talking about, which is try to have a framework to start. And your point about visual is also really interesting, because some people are visual learners, some are audible learners, and so forth. So presenting information in different ways can help to get the message across, depending on what kind of learner you are. And that's what I like about some of the research services that we cover on the investment newsletter group is they have different formats and different visual interfaces and so forth. So what might work for one type of investor or learner may not for another, and that's why it's great.
That's right. You can't, one cap doesn't fit all, And I want to get to that
Right.
very shortly, actually.
Yeah, exactly right.
Any of
So
it very shortly.
if you could give one piece of advice to someone starting out with online share investing, what would it be?
Well, this is what I would suggest. I think what people need to do, and I didn't do this, so I'm guilty of not doing it, but I know a lot of people don't do it. But I think what you should really do if you're starting out with share investing, you should really say to yourself, what sort of investor do I want to be? Now, I don't think anybody does that, and they should. I should have done it years and years ago. I sort of did it intuitively without sort of really thinking about it. It's only more lately that I've thought more about it and firmed up my ideas. But you can basically be a investor who's interested in preserving your capital and making it, building it over a period of time so that you'll have got a nest egg at some future point in time.
Yeah.
Well, that's one type of investor. Now, the other type of investor looks on the share market more or less as going to the races, Instead of betting on horses, you're betting on shares. And I think, well, this is a bit more sophisticated than betting on horses. But what I want to do is I want to make a quick profit. I want to get in there and buy some company and see it double in price, and then I'll sell it and get out with a nice, a nice profit in my pocket and do it again. And after a while, I'll do this and I'll be able to amass a fortune quickly. These people often, they're day traders. They sit all day at the computer and they just trade all day, they buy shares in the morning and sell them in the evening and all this sort of thing. In fact, true day traders don't leave a position overnight. They close all their positions every night. So they might make a profit on just a few cents movement in the share price. But I think you've got to really think about what do you want to do. And when you start out, you probably just want to be speculative. You probably just think, oh, I want to just make a few short, sharp killings on the share market. And unfortunately, it's not easy to do.
About to say.
Very few people can make make a living
consistently
out of share investing just by the profits of the share investing.
It's
very, very hard to do. It's been proven time and time again. People, you give up your day job and think, I can make money on the stock market, and it's not easy to. It's really not easy. So I would just try and dissuade people from trying to make a killing on the market regarding share investing or like gambling. I think you've got to sort of. Now, what you can do is you can do both.
Right.
That's what I tend to do. I have a core portfolio of shares which I'm happy with that I've invested in sometimes for many years. Some shares there I've had for 20 years,
Amazing.
And well, what I did was right at the start, I invested, I bought these companies, I joined the dividend reinvestment plan. Which meant that as soon as they pay dividends twice a year, and those dividends were automatically reinvested. So I was building up my shareholding, doing nothing but just sitting there on the shares I'd bought. So I didn't have to buy any more to build the value up my shareholding. And it will build up over a period of time. If you sort of making a profit of 10% a year, it doesn't take long before you double the value of your investment, And So what I tend to do is I tend to be with a core. So I've got cores and satellites. The core of my shares is
Yep.
where the bulk of my money is, and they're invested in companies, and I'm happy with it. I've invested in for a long period of time. They're pretty sound, solid sort of companies. And then I've got the satellites, which are speculative shares. And what I do is I'm in a situation where I don't devote more than about 5% of my investment capital to satellites. So if an investor's got $100,000,
Yes.
I wouldn't suggest they spend more than $5,000 on speculative shares. But if, I suppose when you start out, probably people do, well,
The
maybe
opposite.
put 100% of their capital
Yeah,
invest
that's
in
right.
speculative shares, and then
The opposite. Yeah.
right, they start to learn, no, this is not as easy as it seems.
Yeah.
Um, but I put about 5% of my investment capital into shares, so
Yes.
I don't do any more than that. So whereas if I buy a good quality share, I'll buy $10,000 worth in one hit. If it's a speculative share, I'll buy more than $2,000, and then
Yep.
I'll see how it goes, see how it runs, and then you can always add to it later on.
Yeah.
If you don't, you've got to get out. You're not going to lose that much money.
I
So,
think,
my one piece of advice was decide what sort of investor you want to be, what your goals are, what are you trying to achieve out of this, and
fantastic.
build your portfolio according to that, what your
Yeah.
goals are. In other words, do it that way around instead of the other way around, where you sort of get to a stage where you've been investing in the stock market for 10 or 15 years, and you suddenly think yourself, oh, wait a minute, what sort of investor am I really? Sure, what sort of capital I wanted to devote to speculative shares, and
And also
you
when that happens,
could say, no, I'm going to go not invest anything, but it is good. It gives you a kick if you buy a share that doubles in value after a short period of time. Well, it gives you a kick and you get a buzz out of that. And I don't bet on the. I'm not a gambling man. I don't bet on any other form of
yeah,
you know, gambling. So I suppose it satisfies a gambling instinct to a small extent. But you know, and the beauty of shares as opposed to say a horse race. In a horse race, you put your money down, the race is run, and you decide, well, I've won or lost.
yes,
Uh, with shares, you can put your money down, you can invest in that share, and then you can see how it runs. And it's
absolutely.
not over in 10 minutes or 5 minutes, it keeps going. And so you've got a chance to go back and revisit it every few days and see how investment's going. If it's not going well, you can pull out before you lose too much. That's
And
what
it pays you
investing.
income,
Then you've got that
income along the way.
opportunity to see how things are going. You
Yes,
don't have to sort of commit yourself and then walk away and say, well, now I'm going to sit and see what happens.
yeah,
You can actually watch it as your investment as it's going along. And, what some people do is they put stop losses on. So they
sure.
say, right, well, I'll buy, say, $10,000 worth of shares, I'll put a 10% stop loss on it. So if this share drops in value, so I'm losing $1,000, I'll sell it. Some people do that. I don't tend to do that because I find that you can get automatically stopped out, which means
May not be the
there's a
fundamentals.
sudden change. Like the ASX, for example, the ASX is the Australian Stock Exchange, but they're also their own company and they're listed on their own stock exchange.
Yes,
And just recently, they had a big dive. And, if you had a stop loss on them, you would have sold them. But when I looked at them yesterday, they'd gone back up again.
yeah,
So you frequently get this sudden dive. And then, so if it's a solid company, they'll generally recover. So you put stop losses on, you tend to get stopped out when you don't want it. So I put stop losses in my own area. I write it down on I keep a spreadsheet. I write on my spreadsheet. Watch this if the price starts dropping or if it gets to a certain level, sell
yeah.
or whatever.
And there's
So,
different systems as well, right? There's, as you say, I think it goes back to your previous point or answer about figure out what type of investor you are first, and then around that you would build your system, for example,
That's
what
right.
we're talking about, right?
That's right.
Things like setting position limits, limits on the speculative stuff, stop losses potentially. So that's, autopilot downside protection. But as you pointed out, it doesn't always work, or there could be reasons that, you want to hold on to it. So it goes back to that. I think goes back to that. Figure out what kind of strategy or what kind of investor you are first. And as you say, not like 15 years down the track when it might be too late, or you might have already burnt a lot of capital trying to figure that out. It's important to
Yeah,
get that.
well, that's putting the cart before the horse. I mean, putting the horse
Oh,
before
true.
the cart. Otherwise, the other way around, you're actually putting the cart before the horse. You're sort of
Definitely.
missing way. And a lot of people tend to do that. They just jump into the share market, away they go. And then some years later, they stop and they say, hey, wait a minute, what am I doing? What am I
Well,
trying to achieve?
have you
Yeah.
heard the expression or this, there's a statistic or a study out there that's often quoted that the average Australian spends more time planning their summer holiday than they do looking at their super or managing their share portfolios. It's
I
like
wouldn't be surprised at all about that.
we have
Uh,
some work to do.
a lot of people, they just say, oh, this is all too hard. I've got an investment advisor, and they just give the whole lot to the investment advisor, and they say, yeah, I've got $100,000. You go and
Yeah.
invest it for me.
Yeah.
And, and
And,
they throw it all into the advisor, and the advisor tells them at the end of the year how much money they've made or lost or whatever. But, I
everyone,
really shun that sort of approach because I think
yeah.
that's, as
Well,
I
that's
said, that violates my very first rule that you've got to take responsibility for your own investment
Yeah,
decisions.
that's a good point. And that's why we're here. That's why we're having this conversation, because our subscribers and your readers, without a doubt, they want to empower themselves, or they are empowered and they want to learn more. And hopefully they have runs on the board already in terms of good results from doing it themselves or doing it together. So it's a very
Or
interesting.
it might be the best thing to have a disastrous
Mm-hmm.
time with your first investments. So
And
to
learn.
realise, hey, this is not as easy as I thought,
That's exactly right. Yeah.
because when times are good and shares tend to go up, everybody tends to talk about
Everyone.
it. You go to the pub with your mates and they say,
Yeah.
oh, guess what? I just made 20% yesterday on the market, or this week I made 20% on the market, and everybody's sort of,
Yeah.
got hype about them, and you tend to sort of want to jump on the bandwagon and get in the hype.
Well, that's where the media are to blame as well. That they love selling the good news or the bad news story because it gets clicks and attention, and it's
Yeah,
easy as a human to get the emotions carrying away the logic. And that's why I think it falls back on some of the great points you've made. Know your system, know what type of investor you are, have a fundamental or a sound selection for picking stocks or investments, whether that's reading your books, looking at the services on our website, subscribing to a couple of those, whatever that might be.
yeah,
That way you short circuit those emotional biases, particularly as I said, the media is a great example, right? They make it sound so easy, and the crypto millionaires that you read about and hear about and so forth, for example, right? That's the current hot areas, I'm sure you're aware. So in your experience, I guess what would you say are the most important qualities or skills that a successful share investor could possess?
Well, I think the best quality a share investor should have, and unfortunately, I don't tend to have this. So I
Self-reflection.
can't speak from personal experience, but I think a good share investor should be rather dispassionate. They should be unemotional
Mhm.
and make their decisions sort of in fairly cold blood, not sort of in the rush of the moment. And we all tend to get caught up in the hype, and a few years ago, lithium, everything's going to go lithium. There's going to be a
Right.
huge demand for lithium and getting lithium stocks and all that sort of thing. And I must admit, I got caught in the hype. I bought some lithium stocks, and they were bloody disastrous.
Yeah.
So uh, I think being dispassionate, and then when it comes to selling, it's a natural instinct. Humans hate to take a loss. We hate to take a loss. It's a terrible thing to have to accept that we've made a blunder or that we've actually lost money. So what people tend to do is just to avoid doing that by hanging on. They say, oh, right, well, the share's gone down 10%, but, it'll probably go up again, so I'll hang on. Right? And then that way they haven't actually made a loss yet. They haven't crystallised that loss. And so that can go on for a long time. You could hang on saying this year, this year's going to get, coming, and it doesn't. So what you've got to be is to be a good share investor. I think you've got to be pretty dispassionate. You've got to set your goal, set your mind to it, and say, right, I'm going to if the share goes down a certain value, I'm going to sell it. And when it does, you sell it. You don't do an arm about the place.
Yeah.
And another thing, I find the share market tends to be, they work a lot on hype. It's like you get the daily newspaper and there's always a hype advertised. There's a hype sort of word, hype sort of business at the front of the paper. What do you call it? Not the byline, or that trying to get people to say, oh, well, we've got to read this. It's good news, but they're trying to hype people up all the time, and
That's right. That's how they sell newspapers.
Trying to sort of make everything appear more dramatic than it is.
Yes.
And unfortunately, the share market gets caught up in the hype. And that's why you see all these sudden drops all happen. And then next thing you know, zoom, they go back up again,
Yeah.
And I think if you can be dispassionate, avoid all that sort of stuff. And so I'm not going to get caught up in the hype. I'm not going to just blindly follow the crowd and make your decisions based on rationale and, without the emotions coming into it, just make rational decisions. And I think you're much better off for it if you could be that way. As I said, I'm not as rational as I'd like to be. I mean, I tend to get emotional too, like everyone else, but
well, we're all human. At the end of the day, if we were robots, the market would go like that. There wouldn't be any extremes, or there'd be a lot less than that. So I think that's a great takeaway is be aware of your emotions. And my take on what you're saying is try to treat it like a business, right? So that you are making cold, rational, money-based decisions, whatever that system is that helps you to do that. But yeah, at the end of the day, we're all human and we get carried away and excited about the latest ideas. So I think
what I did the other day, I had a particular bank, and I thought I've had them for about 20 years, and I thought, as I said, I joined the DRP, and they built up in value, and eventually I thought to myself, I've got too much money in this bank. I've got to get rid of some of it. One of the reasons that balanced my portfolio a bit better. So I made the decision how much value I was going to sell of these shares. And then I sat down and I worked out what I was going to buy with the money. And I did that without having the computer turn on. I just looked at then I looked at a few possible investments, and eventually I came to the conclusion that there was nothing better than the shares I already had. So instead of having my money concentrated all in this one, a lot of money concentrated in this one share, I sold some of it and rejigged them, rebalanced my portfolio. And I must say, I did that. I followed I said, well, I'm going to buy so much of this, so much of that, so much of that, sell so much of this. And I did that, and without any emotional, I didn't worry about whether the market's going up or down. I just did it, and it's, and I was quite proud of myself having done that. And I think that's what investors have got to do. They've got to be able to make rational decisions and try and avoid the hype.
brilliant. No, I think some really good points. Thank you, Roger. It's the takeaway. One of the many takeaways is again, it's about having a framework, a mental framework to help you through those challenges on the emotional side. And I guess to wrap up our chat, if people want to know more about you or your books, where can we direct them?
Well, my website's Roger Kinsky Shares.
Okay. I'm just going to put that up on the screen now. Hopefully you can see that and our viewers can see that.
That's got all my books
Okay, great.
listed there,
Yeah.
and you can buy them all online or
Okay. And you've got some sample
yeah,
chapters for free. That's a good idea.
you can, yeah.
Right. Okay.
So they can buy them straight away or download a chapter for free or whatever
Yeah.
they want. So
Brilliant.
that's a good place. Otherwise, any other place, stockists like Amazon will stocks my books, and you can get them. You can buy them a hard copy if you want.
Fantastic. That sounds great. And any plans to start a podcast or a YouTube channel? That's all the rage these days. You happy doing
Oh
the
well, I wait. I really wait till I'm asked. Usually, somebody will ask for the Money magazine, or I write an article for them. I did,
yes
and you've asked me whether I'd do this
interview?
podcast with you. I said yes, I will. So when the opportunity presents itself, I don't knock it back. You know, but
Good.
it's it's not easy. There's a lot of competition out there. There's a lot of authors, a lot of share investing books, a lot of info out there, but investors can access. So it's not easy. But my books have been selling pretty steadily for many years now. So
It's a good sign.
I'm happy with that.
Fantastic. Well, that's great, Roger. Thank you for your time today, and look forward to getting you on the next chat. So thanks for your time.
Right, that's all right. Thank you, Sean. Thank you, Simon.